Hello, everybody. Welcome to Confident Compounding with Corey Kramer. Today, I'm going to fulfill a viewer request for Toro, ticker TTC. As always, it's not individual investing advice, just how I analyze stocks. If you have a request, put it down in the comments. I will eventually get the ticker on the chalkboard behind me and make a video for you. I'm working through these a lot faster than I have been over the summer, so we should get to your request here in a reasonable period of time rather than a couple months, hopefully. Okay, so let's look at Toro. I'm using a dark mode on the fast graphs this time because I got a request to do that in the last video I made. Feel free to jump down in the comments and let me know what your preference is. I don't think I have I think when I'm at home I'm used to seeing it the other way, but it doesn't matter to me when I'm making the videos, so I'll let you guys sort of decide, and I'll try to remember to set it to dark mode if I can get that in my mind right. Okay, so the first thing is these guys make like I usually think of like snow blowers when I think of them, but like turf management machines, yard maintenance, things like that. And I think they have like a professional division as well. So I don't know what they call them, agriculture and farm machinery. $7 billion company. Looks like they have a little bit of debt, but nothing too crazy. Long history, which I'll look at here. So we have this going back all the way 20 years. And with any kind of manufacturing company, I want to look to see how cyclical earnings have been. It looks like earnings fell about 50% during the Great Recession. Their adjusted earnings, that's this green area here. And you can see the numbers right down here. So it fell 6% and then another 46%. So that 50% threshold is right at kind of where I would consider something a cyclical business. That's usually the first test. So I would consider this a cyclical business. That's going to help us determine what kind of strategy we want to use for them. If we look at their basic earnings, very similar actually drawdown, but when we look at what's happened the past couple of years, a lot choppier, a lot weaker off of the COVID boom than maybe we would see with the adjusted earnings. So I don't know if they had any M&A or not, but adjusted earnings have just been flat to slightly down in an inflationary environment, we're saying. Stock is well off its highs after a big, huge run here. Now, one of the things to keep in mind with cyclical businesses is I don't usually use a PE or a fundamental metric like fundamentals to determine when to buy them. I use them to establish whether they're cyclical and whether they're high quality, and I would consider this a high quality cyclical. I'm kind of surprised that I didn't track it already. I did put it in my spreadsheet to track in the future because I think it's an interesting potential purchase down the road. So what I like to do instead of using fundamentals for these is to go back in history and look at what their previous historical drawdowns have looked like and what the recovery times and everything like that have looked like to help guide a potential purchase in the future. So I did that. So this is a drawdown chart going all the way back to, it looks like about 1990. And we can see that. So that was a recessionary period in the U.S., short one, real estate based, caused, I guess you could say, or Iraq war, however you want to look at it. So we have a double bottom, 50%, over 50% drawdown there. 90, this is going to be 98 probably here. A lot of cyclical businesses sold off before the tech bubble burst in 2000, and this would have been one of them. Again, fell more than 50%. These are probably going to be, looking at the graph, 60 to 65% drawdowns. And then when we look at the Great Recession, top to bottom, I can look at it on the fast graph since that's more modern, but we're probably looking at closer to 70, 75% drawdown. But we have all three recessionary declines that went deeper than 50%. That's actually quite good. They also recovered in a very timely manner within a few years on the 91, 92 decline. Within, call it 1, 2, 3, probably within 4 years in the 2000 era decline. And then even this one, that probably started in 2007 or 1, 2, 3, 4, 5. Yeah, probably about 2007 to 2011. So again, less than 5 years. That's perfect. This is exactly what you want to see for a deep cyclical business. When you want high quality, fast recoveries, drawdowns deep enough that are investable, which usually is like 50% to me. And right now it's at 35% off its highs. So it would start getting interesting, I think, at 50% off its highs based on this. One of the things we do want to consider, though, is are we coming off some sort of super cycle or some sort of bubble? One way to do that is to look at the peak PE ratios. I don't use it for valuation, but I use it before the earnings start to decline, right? And kind of near the peak. So the peak PE back in 2007 was about 19 or 20, we'll call it. And the stock price we saw fell, let's see, got individual years now. That's nice. Let's see, it peaked, we'll call it in about 15. It fell down to about 5. So we'll just call that a 65% decline, peak to trough, in the stock price. So peak PE of 20 produced an earnings drawdown of 50% and a stock price drawdown of about 65%. So let's go see what the peak PE was during this cycle. I won't use this one because the earnings were still rising. So let's use this one. So the peak PE here was closer to 28. So significantly higher. We'll call it 35% higher, 40% higher. That could lead to a deeper drawdown if there's a similar style recession. Balancing that out is inflation, which will raise the floor potentially of a stock price decline, because in real terms, the decline would actually be deeper. So some of that kind of balances out. I think probably the way I would approach this stock here, and some of it would depend on if we know we're heading into a horrible recession, you could be a little bit more cautious. I think starting to nibble at this and ease a person's way in at 50% off the high, which looks like it would be about, let's see, peaked about 116, we'll call it. So what are we looking at? Half of that, like $58 a share, I think. My math is close to being correct. So at about $58 per share, this gets interesting. It looks like it got down to $63 earlier this year. So if a recovery doesn't happen and it takes another leg down, a 0.5% portfolio weighting at $58, and then I think if we have a bad recession, you could probably add more if it gets down to that 65% level, or just kind of layer in a little bit. There's going to be other companies similar to this that will be declining too. So there'll be other opportunities probably in the market. It's unlikely that this is going to be the only company of this sort that's going to sell off that much. I would probably spread my bets around, so it kind of depends on what else is going on. But, if you have extra cash and it's down 50%, I think it's fine to nibble. And then if you don't have a lot of cash, maybe you wait for a 60% drawdown. It's kind of in between, or 65%, since we're coming off this big peak. I think if we had a bad recession, it could fall 75% off its high. So based on previous declines. So that's kind of where I'm at on this one. But thanks for asking for this one. I'm kind of surprised I wasn't tracking it already. At least it didn't look like I was. I didn't do like a deep search or anything, but I don't remember really looking at it before. Interesting little company, especially if the market sometimes gives you gifts. And this maybe is one that people stop paying attention to. You go back to 98 during that sell-off. That's a great example, actually. If everybody gets into AI stocks and all that stuff, and the economy is a little weak, right? It's possible this Toro could sell off 65% in that situation, even with the stock market making all-time highs. And so if the bubble hasn't burst yet and the market has, like in 2000, right? Maybe there's signs of weakness and the government comes in to help, or the Fed, or we kind of see the Fed doing that now already. So there's a scenario where you could be able to pick this one up, and then whenever the tech bubble does deflate, Toro could move in the opposite direction of the market. right? And stocks like it. So it's definitely worth keeping an eye on this one, I think. And at the right price, probably worth picking up a little bit. Okay. If you found this useful, hit the like and subscribe button. I have weekly picks over on Patreon for $25 a month. I also have a free tier on Patreon, where I post probably half of these requests are going to be going over on that free tier. So make sure to head over there. Link is in the description. Also a link for 25% off Fast Graphs if you're interested in trying it out. And I'll see everybody later.